Are you about to make one of your life's most significant financial decisions? Choosing the right mortgage can save you thousands of dollars throughout your term. Welcome to today's video, where we'll unravel the mystery of fixed versus variable rate mortgages. Which one is right for you? Stay tuned, as the answer might surprise you. All right, let's start with the basics. What exactly are fixed and variable rate mortgages? A fixed rate mortgage means your interest rate and monthly payments stay the same for the entire term of your loan. This consistency makes it easier to budget and gives you peace of mind. On the other hand, a variable rate mortgage has an interest rate that fluctuates with the market. In Canada, your monthly payment also generally stays the same, but you'll pay a variable portion to interest and principal. If rates rise, more of each payment goes to interest and less to your loan principal. You'll pay more interest and fall behind on loan payments. So, why is this decision so crucial? Your mortgage is likely to be your most significant financial commitment, potentially spanning decades. Choosing the right type can influence your financial stability and savings. Before we figure out which mortgage suits you best, let's unravel the pros and cons of fixed and variable rate mortgages. Fixed rate mortgages come with several key benefits. Consistent interest payments. Fixed rate loans offer predictable and stable interest payments throughout the loan term. Protection from rate increases. Borrowers are shielded from interest rate hikes, providing more peace of mind. Currently, lower rates. Interest rates for fixed rate loans are currently lower, making them an attractive option. However, fixed rate mortgages aren't without their downsides. Missed savings if rates fall. If market interest rates decline, you won't benefit from the reduced rates. Higher breaking penalties. Fixed rate loans often come with steep penalties for early repayment or breaking the loan agreement. May cost more long term. Over the long term, fixed rate loans can end up costing more than variable rate loans if interest rates remain low or decrease. Now let's move on to variable rate mortgages. Potential for greater savings. When market interest rates fall, you will pay off your loan faster. Lower penalties for breaking. Variable rate loans typically have lower penalties for early repayment or breaking the loan agreement. However, variable rate mortgages aren't without their downsides. Interest rate uncertainty. Monthly payments can fluctuate based on market conditions, leading to uncertainty in budgeting. Risk of interest payment increases. If market rates rise, you'll fall behind on paying off your mortgage principal. Rates are currently higher. Presently, interest rates for variable rate loans are higher compared to fixed rate loans, which may result in higher initial payments. Let's break it down with some real-life examples. Sarah chose a fixed-rate mortgage rate at 3.5% in 2020 for her $400,000 home purchase. Despite rising rates over the years, her payments remained stable, allowing her to budget effectively and pay down her principal more quickly. This consistency gave her peace of mind, knowing exactly how much she would pay each month. Now, let's talk about Mike. He opted for a variable rate mortgage. Initially, he enjoyed lower payments due to a favorable interest rate. However, as rates increased, more of his payments went toward interest rather than principal. Since less of each payment went toward principal, Mike fell behind his amortization schedule. He must increase his monthly payments in the next term or refinance his mortgage altogether. These scenarios highlight the importance of aligning your mortgage choice with your financial strategy and risk tolerance. Now let's explore 3 key pointers to keep in mind when making your choice. Tip number 1. Assess your risk tolerance. Are you comfortable with the possibility of your mortgage interest payments increasing if rates go up? If market fluctuations stress you out, a fixed-rate mortgage might be your best bet. It offers stability and predictability. However, if you're financially flexible and can handle potential rate hikes, a variable rate mortgage could save you money in the long run. Tip number 2. Consider economic forecasts. Experts currently predict that interest rates will gradually decline over the next few years. This could make variable rates more attractive, since you'll benefit from any rate drops without needing to break your mortgage. However, if stability is your priority and you want to lock in today's rates, a fixed rate might be worth the extra cost. Tip number 3. Evaluate your financial goals and timeline. How long do you plan to stay in your home? If you're planning a short-term stay, a variable rate might be beneficial due to reduced breaking penalties. For long-term commitments, a fixed-rate mortgage can offer more security and more accessible long-term financial planning. But what's the expert opinion? Financial advisors often stress that there's no one-size-fits-all answer. Bank of Canada Governor Tiff Macklem has noted that while interest rates are expected to decline slowly, they are unlikely to return to pre-pandemic lows. Eitan Pinsky, a Vancouver mortgage expert, suggests that the Bank of Canada would need to lower its policy rate significantly over the next few years for variable rate mortgages to become cheaper. James Laird, co-CEO of RateHub.ca, advises that Canadians banking on rate cuts should maintain an emergency fund in case their payments stay high. The key takeaway here is to understand your financial situation, risk tolerance, and the broader economic context before making a decision. But what are the additional aspects that could shape your decision-making journey? Beyond choosing between fixed and variable rates, consider other factors like prepayment options, penalties, and hybrid mortgages. Some lenders offer hybrid mortgages that combine fixed and variable rates, giving you a balance of stability and potential savings. Also, be aware of prepayment penalties if you plan to pay off your mortgage early or sell your home before the term ends. Fixed-rate mortgages typically have higher penalties compared to variable-rate mortgages. Additionally, some variable-rate mortgages come with rate caps that limit the maximum rate, providing some protection against dramatic increases. Conversely, rate floors protect the lender if rates fall very low. So which mortgage is right for you? It depends on your individual circumstances, financial goals, and how much risk you're willing to take on. By assessing your risk tolerance, considering economic forecasts, and aligning your mortgage choice with your financial plans, you can make a well-informed decision that suits your needs. Remember, the goal is to secure your financial future, whether you choose a fixed or variable rate mortgage. For more tips on navigating the world of home ownership, don't forget to like, subscribe, and hit the bell icon for updates. Thanks for watching, and see you next time. Stay tuned, stay informed, and make the choice that's right for you. Happy house hunting.